Hello, today we are going to understand the economic term balance of payments along with a real world example explaining the balance of payment for major economies like USA, China. Every country has a financial transactions with the rest of the world. It sells goods, exports the services, receives remittances, earns investment income, and also imports goods, pays for travel, pays interest, and sends dividends abroad. The balance of payment records all of these money flows. So the easiest way to understand BOP is this. It is like the country's international bank statement. On one side, it records money coming in from the world. This can come from exports, services, remittances, and investment income. On the other side, it records money going out to the world. This can happen through imports, foreign travel, interest payments, and dividends. Now, why does this matter? Because BOP tells us whether a country is earning enough foreign currency or whether it needs outside financing to pay for its global spending. Now, let's understand the equation behind the balance of payments. In simple form, the equation is current account plus capital and financial account plus change in reserves equals 0. The current account records the nominal economic flows. This includes trades in goods and services, income and transfers like remittances. The capital and the financial accounts records the investment and the financing flows. This includes foreign direct investment, portfolio investment, loans, and bank flows. Then we have the change in reserves. These are the foreign exchange reserves held by the country's central bank. Now, if a country spends more abroad than it earns, the gap has to be filled somehow. It can be filled by foreign investment, borrowing, or by using the reserves. That is why the BOP ultimately balances. One part may show a deficit, but another part must finance it. To make this easier, imagine the Smith family as if they were a small country. During the year, the family earns $80,000. This includes job salaries, investment dividends, and even $500 of birthday cash from grandpa. But they spend $85,000 on rent, groceries, car insurance, clothes, and a summer vacation. So their current account is negative $5,000. In simple words, they spent $5,000 more than they earned. Now they must finance this gap. They put $2,000 of this vacation on a credit card and they sell an old laptop and some shares of a stock for $1,000. That gives them $3,000 through the capital and financial account. But they still have a gap. How? They were short by $5,000 and they raised only $3,000. So they still need $2,000. To cover this, they withdraw $2,000 from their savings account. In BOP accounting, this reserve drawdown is shown as a positive inflow because it provides the cash needed to balance the books. So the final equations become current account negative 5,000 plus the capital account positive 3,000 plus the reserve drawdown positive 2,000, that is equaling to 0. This is exactly how BOP works. Now, the USA is a classic example of a country with a large current account deficit. In 2024, the US current account deficit was around $1.13 trillion. This means the US bought and paid more to the rest of the world than it earned from the rest of the world. Normally, such a large deficit would look risky, but the US has one major advantage. The world want to hold the American assets. Foreign investors buy the US Treasury bond, American stocks, corporate bond, real estate, and other dollar-based financial assets. So money leaves the US through the current account, but money comes back through the financial account. This is why the gap is financed. The deeper reason is the role of the US dollar and the size of the US financial markets. Global investors see US assets are large, liquid, and relatively safe. China shows an opposite pattern. In 2024, China had a current account surplus of around $424 billion. The biggest reason was its goods surplus. China earned around $768 billion more from selling goods abroad than it spent on imported goods. But the current account is not only about goods. China also had a service deficit of about $229 billion and a primary income deficit of about $130 billion. These deficits reduce the overall surplus. But China's goods surplus is so large that it more than offsets the service and income deficits. So the final result is a still big current account surplus. What happens next? That surplus has to show up somewhere on the other side of the BOP. It may be matched by financial outflows, foreign asset accumulation, or reserve related movements. So here they purchase the US securities, dollars, bonds, etc. So China's surplus helped finance USA current account deficit. In simple words, China earns a lot from exports and that money then moves into the financial side of the balance of payments. India is more balanced example. In FY 24-25, India had a current account deficit of about $23 billion. This means India spent more on foreign currency than it earned on the current account. A big reason is imports. India imports a lot of crude oil, electronics, gold, and other goods. Oil imports and the merchandise trade deficit pull the balances down. But India also has a strong support from services export and remittances. India earns a lot from its IT services, business services, and money sent home by Indians working abroad. On the financing side, India had a capital and financial account inflows of about $21 billion. So, most of the current account gap was financed, but not all of it. That is why the overall BOP was still negative by around $5 billion. India's story is simple. Imports pull the balances down, services and remittance support it, and capital inflows finance most of the gap. Here, India uses its foreign exchange reserves in order to balance the BOP equation. Hence, whenever the oil import is expensive, India balances it with its foreign exchange reserve and its foreign exchange reserve goes down. Next example is of France. France teaches an important lesson. The balance of payment is not only about goods. In 2024, France had a small current account surplus of about 2.7 billion euros. But inside that number, France had a good deficit of around 60 billion euros. That means France imported more physical goods than it exported. However, France had a strong services surplus of about 56 billion euros. Services include tourism, business services, transport, financial services, and other services exports. Tourism is especially important for France because foreign visitors spend money on hotel, restaurants, transport, shopping, and attractions. So, even though the goods balances was negative, services helped offset a large part of that gap. Lower energy cost also helped improve the overall balance in 2024. The key lesson is this: if we only look at goods trade, we miss the full picture. The balance of payments gives a broader view because it includes goods, services, income, capital flows, and reserves. I really hope this was helpful. Thank you.